Okay, right. So this is PM, and we are going to look at the first 5 questions and kind of take it from there. So what do we have here? This first question is asking us about activity-based costing. You remember that ABC is a more refined version of looking at overhead costs. Remember, you have your traditional absorption costing. With ABC, we are able to find the cost drivers. This is really the argument here. We can find what's actually causing the overhead. So it is much more expensive, and we are arguing that it is typically not volume driven. If it was volume driven, we would stick to overhead absorption costing. So we're dealing with such scenarios where we're looking at, I don't know, packaging, setup costs, those type of very sort of broken down overheads. We're pretty much taking the overheads and breaking them down and then allocating them to the products. So in effect, it does give a much more realistic picture. It is an alternative, so both 1 and 2 are correct. Cool, great. With throughput accounting ratio here, we're really looking at a return. It's really saying what is the return on making this product given the fact that we had if in a bottlenecked scenario. So we're really looking at what's the return per hour divided by the factory costs per hour. So return over costs in effect, or the ratio of return to costs. So the question is, what is return per hour? So return, if you like, is what's the selling price minus the direct cost, purely direct costs. Remember, we don't consider labor cost to be one of the variable costs when we look at throughput. We're literally looking at just because we're trying to discourage the holding of inventory in effect. So we just want to purely understand what's just that pure direct material cost, and be as efficient as possible. So this is all part of that whole, totally efficient management processes, if you like, that we're hoping for. So we are discouraging the use of labor costs as part of our direct costs. And again, we're looking at machinery taking a major role in our processes. So what do we have here? So we have 100 minus 40 gives us 60, and that's what the return is, if you like, per unit. And so what do I now have here? I have return per unit, and it's telling me it takes 3.75 hours to make a unit. So that's 60 over 3.75, which brings me to 16. So I'm now at £16 per hour. So my return is per hour is 16. So now what I now need to find is my factory cost per hour. So I just look at all my factory costs, all the rest. Labor cost £10 per unit, factory overhead £30 per unit. So that's 10 plus 30, that's 40, and you're telling me that I'm making 140 units per week, and so therefore I need my hours for the week, 15 times 5 times, and I've got 7 machines. When I do all of this together, I get 1.06. So sorry, I get 10.6. So in effect, now I have my factory cost at 10.6. I have my return, if you like, per hour. So 16 divided by 10.6 brings me to 1.50. So this is favorable. This is a favorable throughput. If you like, every hour I basically, the ratio of my return to my factory cost is almost like £1.50 to 1. So that's worth it. So this is a knowledge question. It's good to go back and read this over time. If you go back again and just look at it, we tend to see a lot of questions here on input versus output, flow costing, that type of thing, looking at the environment. Typically, because it says internal failures, these are borne exclusively by the organization. So that's kind of the theory there. And sometimes you will see that they also discuss this question of appraising your costs. So these are referred to as environmental appraisal costs. So the aim of incurring them is to determine, so not the internal failure here, the appraisal costs, if you like, that's what these are, and whether these are being complied with. So here the answer is just one. It's just one. That's the only thing. Here I'm going to go to my slides. I actually recorded this, but I had my head plugs in. So I'm going to go to the slides and kind of explain what's going on. So carefully look at the information. Again, I remember I used to use graphs for this. Stick with the same policy. That's the same principle. It literally is. I've always thought the sales ratios are actually quite nice in that once you get clearly your contribution here and so here it says you're selling 600 PCs, and it says the C over S ratio is at the time is 25%. So C over S is equal to 0.25, and we know that the selling price, we're told, is 500. So therefore C over 500 is equal to 0.25. The question is, what is C? So C is equal to 125. So contribution is 125. What I'm looking for is change in contribution and the change in the number of units. So just looking at volume, you thought you were going to sell 600, you sold 642. So there we are. So in terms of the initial template, this is the initial picture. You then go and do this. I'll change my pen color here. This is what happens. But I won't do the sale. I'll just look at volume first. This is purely volume. Remember, I'm trying to tease out the different ratios here. Both of them, of course, add up to the entire sales variance. But the question here is, what is the sales volume variance? That's just the difference between these two. That's 42. I sold 42 extra. It's favorable. Times what? The contribution. That's what's going to affect my income statement, isn't it? The actual difference in contribution, if you like, before fixed costs. That's why I'm interested in the variance. That's what the variance is about. What affects my actual contribution in the end. So 42, an additional 42 positive times 125. So 42 times 125 takes us into 5,250, and that's favorable. Changing my pen color now, you see that in terms of pricing variances, I had to drop this by a certain amount. The question is, how much did I drop it by? It sells you ended up selling these things for 465. So if the plan was to sell it for 500 and you're selling for 465, you have an immediate fall in contribution of 35. So your contribution coming in as a result of you doing this thing, of dropping it, is 90. So in effect, your price difference, or your price variance, which is your difference in contribution, is this bit over here. So you have 35 times 35, a fall in 35 right across all the units that you've sold. So you have 35 times 642, which takes you to a fall of 22,470 adverse. So your answer there is A, right? So you have 4. Sorry, when I say A, 4 is D because that's unfavorable, so not A. But for 5, you have your answer is C because that was favorable. So just going back very quickly to that, yes, here we have it's D, it's adverse, and here we had a favorable variance here. Okay, great stuff, and I will see you in the next set of videos.